Alright folks, this is going to be our algorithmic discussion in lecture 4, model number 6, universal trading, specifically dealing with the buy-side low resistance liquidity runs and fractals. Alright, so obviously without going through all of the details as I've already done in the previous videos for this model, in the time that you've been spending with me, obviously you can see that there are lots of market maker sell models, market maker buy models, and because they're fractal, that means they can appear and form on any time frame, but without the logic of the narrative. Why should it go up to a specific level? Okay, we're looking at a market maker sell model here, and there are two stages of accumulation. When I'm looking for a price run from whatever the market price would be, and say I'm bullish, the first thing I'm doing is I'm going through the time frames highest to lowest, and I'm looking for some kind of narrative that would be utilized for the price to be drawn up to a specific key level as a form of a premium array. Now, if I go into the marketplace and I'm looking for shorts, and I have room before where the market price is at the time of me sitting in front of the chart and where I think the market's going to create that short entry, if there's enough range there, I'll always consider using the buy side of the curve of a market maker sell model. That's basically like the blue shaded area here. And I may not get the first accumulation. So what I'll look for many times is a second stage of reaccumulation that sets me up a run up into that premium array. There's examples of me on my YouTube channel when I used to do it on YouTube, and have since deleted some videos obviously because they had music in them. Back in the old days when on Twitter I would show examples of me buying and selling the same instrument, and it was me using what I'm showing you here. Okay, so it's not a matter of me getting in front of you with a chart and walking you through it, because there's so many examples and so many variables. This is why I dubbed it a universal trading model, because you're going to learn over years of experience. Okay, even if I showed you an example every single day, it still won't scratch the surface of the flexibility knowing how to read price and utilizing this framework will give you. If you're looking at, say, the market's trading here, and say it's the S&P, okay, I used this idea this morning with the S&P E-mini futures June contract for 2022, and accumulation, reaccumulation up to a premium array. Now the problem I had at the time was I was not sure exactly where the premium array was, but I knew it was going to draw up higher because we were failing to make a lower low, and it should have broke at 8:30 news and tapped into the sell side low of the marketplace. It didn't do that. So I seen the shift in market structure, something to this effect, came back down into a fair value gap. It even overshot the fair value gap, but I was still confident that the trade would likely pan out because there was a reason for it to go to a premium. We were already at a discount ahead of the 9:30 opening for S&P. So I was using this framework here, accumulation, reaccumulation, but I did not know with any certainty as to what the objective would be on the upside. So I just used a nice easy objective, a fair value gap below an old high, which happened to get run out later on. So I didn't get the actual run highest exit strategy or price point, but I didn't need it. Okay, so I was using this universal trading model, model number 6, using the buy side of the curve of a market maker sell model. And that's a whole lot of stuff coming out of my mouth. But if you've been with me long enough, everything I just said makes sense to you. But this is also what I meant when we would get into the algorithmic theory, because it won't help anybody that hasn't already gone through the content and studied and been with me under my wing for at least the minimum of a year. So I want to counsel you to go through all time frames each week. Like, go through, find price runs that have a nice sell-off or a rally from them beginning at a specific price point, and then backtrack that and see if there is a market maker buy or sell model that's linked to that. And you're going to find that most of the time that's the case. So when we're looking at first stage and second stage accumulation before the turning point of a market maker sell model, you can use, for instance, that market maker accumulation phase here and hunt the YouTube model that is our model 13 entry strategy. Or you can use a simple fair value gap that's over here that's coming back down, and that's your long there. And the same thing here. So I want you to think about how you can utilize entry strategies with this premise in mind. But generally, you want to know where it's reaching for. Some kind of a target, some kind of a premium array. And I know that the folks that went through 2021 that rushed through it, especially the folks that paid an accelerated pace, they're not going to get that much from these videos. It's going to feel incomplete or disjointed. And it's only because you don't know what you should know before watching these videos. So in other words, the algorithmic theory videos are really like the conversation that I would have if we were having like a workshop for the full week. And each day I was teaching you components and ideas and how each thing fits together and what you should be looking for and what you shouldn't be looking for and how to navigate this and what to expect here and there. You should have things under your belt already. So that way when I'm casually talking about things and giving you my best advice for what you should have gleaned from all of this being under my mentorship is primarily that all of these things fit together. You can't fit them together yet because you're so new at doing this. But if you focus on the fact that you can't do it right now and you get frustrated with it, it will keep you from ever getting good at doing it. And you just got to continuously press into it, back testing, seeing examples, journaling. Okay, that's the number one thing, journaling and annotating your charts. So obviously the concepts work. Obviously this model is, the closest thing to what I'm actually doing in my trading without actually giving you my actual trading model. But this is very, very close to it. And you can see I absolutely lean on these teaching models to show you what I can with the language I've created without divulging too much. So when I show my examples, you can clearly see the logic in these market maker buy models and sell models. You can see the logic of me entering and pyramiding entries. Okay, when I'm doing more entries, except for times where it doesn't give me an opportunity to do a pyramiding. And when would that be? If we know that the market has already ran up, okay, and say I have a target or a premium array up here, and it runs up at least above 50% of the run from where I'm thinking the market starts its run to a premium, but it runs 50% of that, then it retraces. I'm going to assume at that moment that we're only going to have one stage of accumulation. That means I can't do any pyramiding. So when I'm looking at a run from market price to a premium, I'm anticipating this type of run here. But I need it to have at least two stages or I can't pyramid. So if I'm going long in here and then I get this long here, I can pyramid. Or if I go long here and it runs up and falls short and starts to retrace, then I can pyramid again because I know we have yet to reach the premium array for terminus. So I'm not trying to pyramid for the sake of pyramiding. It has to have an unrealized range still in the marketplace, meaning unrealized is like from here to the target I was looking for, or from this low to the target I'm looking for. That's unrealized range. So that doesn't mean that you are going to get that objective. It just means in my thought process, the inner dialogue is I'm looking for runs that will hopefully give me a fair value gap, institutional order flow entry drill, a short-term sell stop run, and then rally. So by having these ideas and utilizing what I've taught you from conceptual entry strategies to money management and also pyramiding, they all come together when you have the experience behind you to see them before they form. And it sounds lofty. It sounds, mythical. But you've seen many examples, and just, in the small little vignettes I do on my now Twitter account, again, you can see it. You can see the examples that I show on the YouTube channel, because I make those examples always public. There's never been any secret, private interpretations or examples shown just in the mentorship. Okay, I might amplify things that I've shown publicly, but I'm not really doing anything in here that's private, because I want every bit of the evidence I'm ever going to submit, it's going to be in public record. So when we have these moments where it gives you at least 2 stages of accumulation and we're bullish, you may elect to only trade on this side and may not want to trade short up here. That's fine. For the aggressive dynamo, okay, and I'm sure all of you, especially the young guys, are wanting to do that because you've seen what I've done, and it seems like elite, status, where you're buying, selling it near the high, and then shorting it, riding it down to a low, covering, and buying again, riding up to a short-term high. That's phenomenal trading, okay? I'm not going to pull any punches. To be able to do that, you're really dialed in. You aren't going to be able to do that right away. But utilizing what I've taught you, you can go and grow into that, measure of aptitude. But trying to rush to do it right away for the sake of being able to say, I can do it like ICT, or I can do it because, I'm better than everybody else, that shouldn't be the motivation. The motivation should be, can I find a setup that's repeating all the time from here or here to a level that repeats with my consistency? Am I able to find that type of framework? And if you only have one stage of accumulation here, you know that you're going to probably be in a parabolic price run, unless you're bearish and it's going to be in a hurry to get to that level just to go down. So that means you'll be pressing more on the sell side, which we'll talk about in model number 7's algorithmic theory. So using the examples from what I showed on Twitter this morning, May 31st, 2022, you can see prices consolidating in here. And I felt that they could have taken this high, but I was more interested in the relative equal highs here, admittedly. But ended up going above and sweeping that. So I was bullish because we did not take out the sell side here. We went down real close to it, and we had a fair value gap in here. So I was thinking, okay, I want to be buying in the fair value gap, which I did. My stop was just below the low. And it got close, but I was confident that it wasn't going to do it because it should have already ran it. And the fact that it was being very slow and lethargic about it, and it was ahead of the 9:30 opening. So 8:30 news couldn't push us down. Okay, so here's 8:30. We went lower here, and then we rallied up. Short-term shift in market structure with a fair value gap. Going long, stop loss below the swing low. That's it. Watch what happens, though. It rallies, offers me profitability. What's this? It's returning back to the original consolidation, right? So this is first stage of accumulation. You could be a buyer there with the expectation that we would run relative equal highs, or best case scenario, which I was not expecting. I felt it could happen, but my interest was really lying here initially. So you could be a buyer here with that target there. And here's second stage accumulation. Here, fair value gap, drops down into it, and then delivers to the premium array. And then what happens? The sell side of the curve begins, and it takes off and trades aggressively lower, taking out the original consolidation and digging into a deeper pool of liquidity. On the market maker buy model, focusing on the buy side low resistance liquidity runs and fractals, we're looking for instances where we expected the market to turn down here. Okay, and as luck would have it, I have another example of that today. So the market trades down into a level that I think, or you'll interpret it as a discount, and then you wait for some measure of reversal. Okay, a shift in market structure, a low risk buy, and then accumulation, and then reaccumulation, second stage, and it runs to clear the original consolidation for that liquidity. This pattern, if you haven't already noticed, and I should have mentioned this on the previous slide talking about the market maker sell model, but it's interchangeable. Everything is reversed in terms of the logic. But this could be a weekly profile. This could be an intraday profile. This could be a monthly profile. So in other words, all these price swings are fractal. But the expectation of what is it doing? It's consolidating here to go down. Why is it going to go down? It's going to go down to go higher. That's narrative. Going in a consolidation, breaking, retracing back here. Is it retracing here to go higher than this? Or is it retracing just to go short? It's retracing just to go short. So that's distribution. First stage distribution. Second stage distribution. So when we get down to this level here, we're looking for a point at which price basically proves to us that it wants to go higher. And that'll take place in the form of a short-term market structure shift. And you can utilize what I've taught on the YouTube channel model for that to make it very simple and simplistic. Then we wait for evidence that shows us that it wants to go higher. So every time there's a point of up candles on the sell side of the curve, that means the lowest point to the left. Here is a point at which there's up close candles, or what would be expected as up close candles prior to that move lower. Same thing here. Up close candles somewhere in this price swing. We carry them across the curve. That means this turning point here. This level here, we carry that through the curve as well. So we're looking for a retracing back down into an old area distribution becomes a new level of accumulation. So first stage accumulation is here. You could be a buyer. And the second stage reaccumulation, that's where the most dynamic price move is going to occur. And then it rallies. So I'm looking for this phenomenon to occur in every time frame I'm looking at. If I can find it, and it fits the narrative of why I think price should be doing what it's doing, and it fits a bias that I feel comfortable with trading with a higher time frame bias behind me, and it's time of day and day of week, and it's maybe even a seasonal tendency, not that you have to have that, but that even helps a lot more, then it gives me the confidence to be able to take the trades. And like, I get a lot of questions still by members from the 2016 group. How do I know to trust the fair value gap? Well, it has to fit this kind of logic here. And if I get a fair value gap in here that overlaps with a old area of distribution, I'm going to trust that fair value gap isn't going to be broken to the downside and just break lower. If it does, that's okay. I'm paying a stop loss to do its job. Same thing over here. If I see an old area of distribution now becoming an old area of distribution, now reaccumulation, that is an area I'm going to trust because I have the narrative that we're likely to go above these highs. We went down to go up. We showed a shift in market structure. We showed accumulation in here. Now we're in the area where it should reaccumulate. So if there's a fair value gap in here, or institutional order flow entry drill, I'm going to take that trade with the expectation that I don't think it's going to close in the gap and overlap it and go lower, in other words. So I'm trusting it because I have other confluences behind me. So I'm not going into the marketplace with just one of these ideas that I'm teaching you, and that's all there is to it. That's not what I want you to view in my interpretation of price action. I don't want you to make a model out of one thing. Just the fair value gap alone is useless in the hands of a neophyte. So you have to have all these things behind you. And if you just look at the comments in my Twitter or my YouTube channel, the folks that are just now trying to learn how to do this, they're rushing to go in there and trade with live funds. They're making mistakes because I thought I saw this fair value gap here, or they'll send me a message and they want me to more or less co-sign their trade. That was always the case even in the mentorship groups here. People would always send me emails, and they largely would go ignored because they want me to give them a seal of approval. I don't have time to sit down and look at everybody's emails, number one. Two, if I tell you, or if I give anybody else feedback about their trade, it's not their trade, it's my trade. And you're not going to learn anything except for codependence. So you have to go through the process, and it's not easy. This is the hard part, the work of going through when it doesn't feel like you're ever going to get. That's the normal process with anything that's technical. Anything worth having or knowing is always going to come with a great deal of hardship and, well, adversities. But it's worth it, folks. It really is worth it. And times are about to get really, really difficult. And if you can find yourself in a position where you can at least make half of what you normally make at your job, if not replace the entire income, that is going to be a blessing. But you don't want to put all of your expectations on one individual thing that I taught you, like a fair value gap or an order block or an optimal trade entry or institutional order flow entry drill. You're hopefully doing the work behind the scenes and looking for this overall price structure here, but focusing on the buy side of the curve when it's a market maker sell model, and it should have gone down to these levels here to go higher anyway. That's narrative. In other words, it's going down, digging in deeper. It creates a short-term low, starts to rally, so that way what? Retail will want to buy it. It goes down a little bit lower, stops those individuals out, and then starts to do it one more time. And they think, okay, I was wrong. I was a little bit premature. Let me go and buy it again. And they put their stop loss right below here, and then they run it out again. Then goes into the level that we would be expecting. This could be a larger, higher time frame fair value gap. It could be an order block. It could be a breaker, okay? Or it could be just simply an old high being returned back into. And those ideas are going to be linked to your unique model. There's, like I said, there's tons and tons of trade ideas and opportunities each month and each week, and several of them intraday. And even though you're all learning these concepts collectively as a community, you're going to be hard pressed to find, a dozen traders doing the same thing at the same entry price, same stop level, same target, because they're bringing in their individual personality. But these things I'm showing you, these are the blueprints. These are the framework in which you look for the setups and justify why you're doing and anticipating price doing a specific thing. And if it doesn't fit this criteria here, then chances are you probably are doing something that's forced, or it's simply not in the market. And if the market starts to move from the level we expect down here, and we expect it to run up here as a target above the original consolidation, if that's the case, and we have one price run up above 50% of that range between the high and the low here, and it starts to retrace, then I'm thinking we're only going to have one stage of accumulation. So I can't do any pyramiding here. But if I have one here, and it goes about halfway or a little bit less and pulls back down in, then I know I have a chance to pyramid. So I can do a long here, say maybe 10 contracts of the S&P. Then I can do 5 here. And if it gives me some kind of little institutional order flow entry drill here, right before it runs out the highs, and I think it's going to be moving higher, not just here, then I could add another 2 contracts. So it would be 10, 5, and 2, or 10, 5, and 3. Something to that effect, okay? And that's pretty much what I'm doing. Like, I'm going through the process of looking for this structure in price that meets and agrees with the narrative I'm expecting for price for that particular session or that particular day or that particular week, okay? Because these profiles, these market maker buy models and sell models, they're not limited to any one particular time frame. But the logic behind them, and when you're looking for specific things of accumulation or distribution, they have to meet what I explained, and it's not Wyckoff, okay? It is very specific elements that have to balance themselves out based on what side of the curve price is on. All right, in the S&P, again, same thing this morning. This is a chart I shared on my Twitter feed beforehand. I mentioned that we would see these stops here taken, and once it was cleared out, we would expect price to, and I would rather expect to see price trade above the 41.43.5. So buy side resting over here. If you looked at the first example I showed in this algorithmic discussion, this was the first stage of accumulation, second stage accumulation, and then it hits the premium array. okay, which is the old high back here. It went just above the gray line here. That's what it's doing. Now this becomes an area of buy-side liquidity after the market breaks down. Notice there is no real retracements for first stage or second stage distribution. So because of that, this decline down here was just them running out sell side, and then they gave one more instance where they created a low. Anybody was long, they knocked those individuals out because they engineered liquidity. Then it started to rally. We had a fair value gap in here, rallied, fair value gap here, rallied, went back into the last fair value gap here, and then dropped to an area of sell side. What is this? What's this right here? That's an original consolidation that's below the buy side here. So when I was watching price, I'm looking at this as, okay, this is a market maker buy model. So I want to be buying on the buy side of the curve. That means it's got to turn around. So I'm waiting. Admittedly, I bought early over here, and I had to weather this. My stop was not touched, obviously, but as it dropped down, I could have easily had a losing trade, but the logic was still there. The market went down, cleared out that level again, and then got to this price point here. And I tweeted this chart. I said, this is where I think it's going to go. And there it is. Now we're ready to go higher because we've taken the sell side out. So smart money has accumulated down here, all the sell stops. Where do they want to get out at? Above here, where I took a partial, and above here, where the buy side liquidity is. So in this little fractal here, I'm expecting a market maker buy model to form. So here is the 1 minute chart, and we're looking at that same consolidation and the old high that I think is going to be taken out on buy side. And the market has this area of old distribution, becomes a new level of accumulation over here. So here's the curve, sell side of the curve here. To the right of it is the buy side of the curve. Smart money reversal, low risk buy, accumulation, reaccumulation, second stage, and then you see the extrapolated price run. So the buy side is targeted there. The original consolidation is here. So we have initial draw here and then here. First stage accumulation, second stage reaccumulation. That swing low sets the stage for that dynamic price run. All the energy is there on the second one, and it runs us up into here and here. And I basically outlined this whole thing with a simple discussion with what I expected on Twitter, without going through the mechanics of everything I'm showing you here. Now, more specific, we can drop down to a 15-second chart, which I had available to me, and I'm not going to share this, obviously, because it would be teaching mentorship on Twitter, and I'm not doing that. But here's the original consolidation. Up close candle, carry that through to the buy side of the curve. You can see it drops down into that for second stage accumulation. Up close candles, carry that through to the buy side of the curve. You can see we went down into that and accumulated again. So we have first stage accumulation, you'd be a buyer there. Second stage accumulation, that's the one that has the most dynamic price run, and you can see it there. So everything that I'm teaching you, if you have the idea of where the market's going to draw to, okay, which is why I always preach this all the time, this is the most important thing. It's not the entry points, okay? It's not. It's knowing where the market's going to go, because if you can have that idea and be correct about it most times, and you're able to look for this pattern, you will be able to trade every time frame, whether it's a 15-second chart, 1 minute chart, 5 minute chart, 15-minute chart, hourly chart, 2-hour chart, 4-hour chart, 90-minute chart, daily chart, weekly chart, monthly chart, quarterly chart. You get what I'm saying, right? I'm being obnoxious now. But the point is, you're going to be completely unshackled. You're going to have no limits, none. And you'll be able to trade every time frame in every fractal. Now, that is not an invitation to go out there and try to trade like a madman, okay? You have to have some kind of discipline. But knowing what you're looking for and blending the things that you've been taught here, that is how you get the results. You can't just take one thing on the basis of just that one thing. You have to have confluences. And the experience factor will grow as you do it more and more. And do not be afraid or discouraged if you get it wrong. Because when you get it wrong, that's where you're learning. Don't look at doing things wrong while you're developing as failure. That's where you learn. You have to understand that that's a moment for you to understand more than you did before you did that exercise or that paper trade or whatever it is you did that you concede as a failure. When it's not failure, that's a growth pain. And growing pains is part of all this stuff. Okay? So if you found this one insightful, until I talk to you next time, be safe.